Welcome to the Deep Dive. Today we're tackling a really significant issue that's been making headlines, the potential for a major economic split between the United States and China.
Right. It's definitely something a lot of people are talking about.
You've likely heard about the trade friction, the tariffs, the general tension. What we want to really get into for you is the nitty-gritty. What would a complete economic separation actually mean for everyday life, for the globe?
And we're drawing on quite a bit of analysis here, including some pretty stark warnings, like former U.S. Treasury Secretary Janet Yellen called it potentially disastrous back in 2023.
Exactly. So this isn't just tinkering around the edges.
No, definitely not. We're talking about potentially unwinding decades of really deeply embedded economic ties. The scale is just huge.
Which is key to understanding the fallout, right?
Yeah.
So we're going to explore 10 crucial reasons why this economic divorce, as some call it, would likely be incredibly painful.
We'll look at impacts on, the price of things you buy, the industries, the global economy as a whole.
And we're using info right up to April 2025, including President Trump's announced 125% tariffs on Chinese goods. That's the big factor.
A huge factor. And to really grasp the potential disruption, you have to think about how much trade has grown since China joined the WTO, the World Trade Organization, back in 2001.
Right. The WTO sets the rules for trade.
Yeah. And by 2023, trade was, what, $513 billion? A staggering amount. Although there's that big trade gap, about $201 billion. The U.S. imports a lot more from China than it sends back.
Okay, so that huge growth.
Yeah.
It hasn't been simple, has it? On one hand, yeah, lower prices for us, lots of consumer goods, and big profits for some U.S. companies.
Definitely benefits.
But on the other hand, we saw manufacturing jobs lost here in the U.S. because of that competition. So it's complicated.
It is, and understanding that complexity is crucial to seeing why pulling it all apart now would be so disruptive.
So the big question is, can you actually untangle these economies without causing just massive widespread problems?
And the analysis we've looked at pretty much says probably not. A firm no, really.
Okay, let's dive into the first reason then. Something that hits close to home. Higher costs for everyday goods. Seems obvious, but why fundamentally would this split make things more expensive for people?
Well, the basic point is China's role. They've become this powerhouse for producing affordable stuff. Think about your phone, your clothes, kids' toys.
A lot of it comes from China.
A huge amount, because production costs there have historically been lower, and that's shaped how we shop, what we can afford.
They're like a central cog in making all this everyday stuff. And then you add these massive tariffs like that 125% announced in April 2025. How does that directly mean I pay more?
Okay, so think of tariffs as basically a tax on imports. The idea might be to boost local production, but the immediate effect: costs go up for the companies bringing those goods in.
Right.
So those companies have a choice. Eat the cost, which hurts their profits, or
Pass it on to us.
exactly pass it on to the consumer, higher prices on the shelf.
And we've actually seen this happen before, haven't we? This isn't just theory.
No, not at all. The 2018-2019 trade war is a perfect example. We saw prices jump maybe 10% to 30% on certain things.
That's noticeable.
Very noticeable in household budgets. You probably felt it.
And it's not like everyone feels it equally, right?
Yeah.
Sounds like it hits some people harder than others.
Precisely. Low-income families often depend more on those affordable Chinese goods just to make ends meet. So when those prices jump, it takes a bigger bite out of their budget.
Yeah.
It's not abstract economics. It's about affording necessities. It has real unequal impacts.
Okay, so higher prices, that's a big worry. But what about the ripple effects? How things get made, how they move around the world? Let's talk about potential chaos in global supply chains.
Right. This is where the analysis really shows how tangled up U.S. and Chinese industries are. It's not just finished goods going back and forth.
They're like integrated into each other's factories.
In a way, yes, deeply integrated. Think about essential components. Computer chips, batteries for phones, laptops, EVs, specialized machines that factories use everywhere. China makes a lot of that critical stuff now.
Okay, so if you just cut that connection, what happens?
Well, you'd likely see major shortages, big delays. If a U.S. factory suddenly can't get those vital parts from China, production lines could just stop.
Wow.
And get this, something like 43% of U.S. imports from China aren't even finished goods. They're materials or equipment that American factories use.
43%. So it's not just my new gadget being delayed, it's factories here potentially shutting down.
That's the risk. Industries like cars, tech, they rely heavily on these imports. A split could mean shutdowns, layoffs, less stuff being made overall.
Hmm.
And this isn't just us saying it. The World Trade Organization warned in 2025 that these tensions could cause like a 1% drop in global trade. That's significant.
That is concerning. Okay, let's shift focus a bit to American companies. Many do huge business with China. What kind of hit could they take in this divorce scenario?
Yep. Yeah, that's a key angle. Many big U.S. companies depend heavily on China, both as a place to sell their products, it's a massive market, and as a place to actually make their products.
Can you give some examples, big names?
Sure. Think Apple. China's a huge market for iPhones. iPads, they had like 51% of the iPad market there. And of course, that's where most iPhones are assembled.
Right.
Or Boeing, they rely heavily on orders from Chinese airlines. Ford sells a lot of cars there, builds them there too. These companies make serious money in China.
So if that door slams shut, or even just gets harder to go through,
It's a direct, painful hit to their bottom line. Less market access means fewer sales, lower profits, and if they have to move production somewhere else, say Vietnam or Mexico,
that's expensive.
very expensive, big investments, logistical nightmares, probably disrupts their whole system for a while.
Didn't we see some of this financial pain during the earlier trade fights?
We did. Research on the 2018 trade war showed U.S. companies actually paid most of the tariff costs themselves, billions in losses. And a full split would be much, much worse. In fact, early 2025, some analysts were talking about a potential 15 trillion hit to global stock markets just from these tensions ramping up.
15 trillion pounds.
Yeah.
That's hard to even wrap your head around. Now, one argument you hear for tariffs is, oh, it'll bring manufacturing jobs back home. But the analysis suggests maybe not, maybe even the opposite.
Yeah, this is a really important and kind of counterintuitive point. The simple idea is tariffs make imports expensive, so people buy local, creating jobs here, but it's often way more complicated than that.
And there's that term, the China shock, that illustrates part of the history here, right?
Exactly. That period, roughly 1999 to 2005, after China joined the WTO, imports from China surged, and studies showed it did contribute to significant job losses in U.S. manufacturing sectors that were competing directly.
Okay, so that happened. But why would these new high tariffs, like the 125% ones, potentially hurt U.S. jobs now?
Well, the key difference is what these tariffs are often hitting. They're hitting intermediate goods, the materials, the components, the machines that U.S. manufacturers themselves need.
So not just finished products.
Right. If a U.S. factory needs a specific machine from China and suddenly there's a 125% tariff on it, their own costs skyrocket. That makes their product more expensive, not cheaper.
Okay, I see.
So instead of hiring, they might have to cut back production, maybe delay expansion, or even lay people off because their costs are too high. The tariffs could actually cost U.S. manufacturing jobs in some areas.
Especially hitting those intermediate goods.
Exactly. And add to that the growing warnings in April 2025 about a potential U.S. recession. Any job losses could feel even worse.
That's a critical distinction. Okay, let's flip the coin. What about China? What kind of economic pain would they likely face in a split?
Yeah, it's crucial to remember this cuts both ways. While we talk a lot about the U.S. side, China's economy is also deeply tied to the U.S., and a split would absolutely cause them major problems.
And they've had their own economic issues recently, haven't they?
They have. They've been dealing with a big downturn in their property market, high youth unemployment. Remember, it hit nearly 17% back in 2020. Their growth model has been heavily based on exports for a long time.
And the U.S. is a huge customer.
A critical export market. Plus, they get a lot of investment from U.S. companies setting up shop there.
So if those exports plummet and U.S. investment dries up,
it puts a real drag on their economy. Some research back in 2021 suggested a full decoupling could knock maybe 2% off China's total wealth.
2% sounds small, but for an economy that size,
it's massive. And consider exports to the U.S., that was around $130 billion in 2020. Losing a big chunk of that hits Chinese factories, hits their workers hard, and of course, major instability in China. That sends ripples everywhere globally.
Absolutely. An interconnected world means trouble spreads, which leads nicely to the next point. This wouldn't just slow down the U.S. and China. It could slow down the entire global economy.
Right. This is where you see the truly global scale of the problem. Yeah. The U.S. and China are, they're the two biggest engines of global economic activity.
Like two giant ships pulling the whole convoy. If they start pulling apart.
Exactly. The whole convoy slows down. A big drop in their trade and investment relationship would almost certainly mean slower global growth overall. The IMF, the International Monetary Fund, saw this coming back in 2019. They said the trade disputes were already hurting global growth by messing up trade flows and making businesses nervous.
And things have only gotten more tense since 2019.
Definitely. That World Trade Organization forecast for 2025 a potential 4% drop in global trade from tariffs really highlights how serious this could be globally.
Now, some might say, well, maybe other countries could pick up the slack. Manufacturing moves to India or Vietnam.
Sure, some countries might see some gains. Companies are looking to diversify away from China, we see that. But places like India or Vietnam, they just don't have the sheer scale, the infrastructure, the workforce that China does.
Not yet, anyway.
Right. They can't fully replace China in the short or even medium term. So while some might benefit a bit, the net effect globally is likely still a significant slowdown, a drag on growth for everyone.
So we've got economic pain, slowing growth. It sounds like this could also pour fuel on the political fires globally. How might an economic split worsen political conflicts?
That's a critical link. Economics and geopolitics are rarely separate, right? And with the US and China, their economic rivalry getting sharper could easily spill over into more political conflict worldwide.
What are the core political tensions here?
Well, from the U.S. side, there's this growing worry about China's economic power challenging, the existing global order, U.S. leadership, plus long-running complaints about things like intellectual property theft, stealing ideas, and unfair trade practices.
Okay. And China's view.
From Beijing's perspective, they often see the U.S. as trying to unfairly hold back their economic rise with protectionism, trade barriers, trying to contain them.
It really does start to sound like a new Cold War narrative.
There's definitely a real risk of that. You could see both sides digging in, strengthening their own alliances. Maybe China gets closer to developing nations, the U.S. works more with India, Europe.
Dividing the world into blocks.
Potentially. And that kind of polarization, unfortunately, raises the chances of more serious disputes, maybe military tensions and hotspots, maybe more cyber conflict. It threatens global stability. Even back in 2012, people warned about a messy divorce, souring relations. Now that risk seems much higher.
A worrying prospect. And it's not just about today's conflicts. It could actually hold back progress, especially with technology, right? How does the split affect innovation?
Yeah, that's another major downside. You have to recognize that both the U.S. and China are leaders in tech, but often in different complementary areas.
Like what?
Well, China's pushed ahead incredibly fast in things like 5G, certain areas of AI. The U.S. is still very dominant in, say, software, advanced chip design.
So they bring different strengths to the table.
Exactly. And when you start breaking apart those connections, like we've seen with U.S. bans on exporting certain tech to Chinese firms since 2018, you stop collaboration, you slow down the flow of ideas, and that just slows down innovation overall.
If the best minds can't work together or build on each other's work,
Progress stalls. Research can't move as fast. We actually have some numbers on this. A 2024 study suggested a tech split could shave about 0.41% off U.S. wealth and potentially more off China's, just from missed innovation opportunities.
wow.
And think about the big global challenges, climate change, finding new healthcare solutions. Progress there relies so much on international cooperation and sharing technology. A split makes tackling those huge problems much harder.
It really underscores how interconnected progress is. Okay, let's talk finance. This can make people nervous. How could an economic divorce shake up global financial markets?
This is where that deep financial interdependence really matters. It's not just trade. China holds a massive amount of U.S. government debt treasury bonds.
They lend money to the U.S. government.
Essentially, yes. And on the flip side, U.S. investors, pension funds, individuals, they have huge amounts invested in Chinese companies, Chinese stocks and bonds.
So if you mess with those connections,
You risk serious volatility, shaking things up. Remember that 15 trillion potential stock market drop mentioned for early 2025. That was linked directly to fears about these rising tensions.
investors getting spooked.
Exactly. And imagine if, say, U.S. pension funds were forced to sell all their Chinese investments quickly. That could cause chaos in the markets.
And what about China holding all that U.S. debt? Is that a risk?
It's definitely a point of leverage, or at least concern. If China decided to stop buying U.S. bonds, or worse, start selling off the ones they hold, even gradually, like they did a bit back in 2012.
What would happen?
It could push up borrowing costs for the U.S. government, make it more expensive for the U.S. to finance its debt, That puts pressure on the U.S. economy.
So it's a really delicate balance financially. Disrupting it could cause widespread problems for investors, for governments, for stability.
Absolutely. It's a fragile system in some ways.
Okay, one last area to cover. What about the countries caught in the middle, the smaller, poorer nations? How do they fare if the two giants divorce?
This is where the human cost and the geopolitical shifts really hit home for many parts of the world. Lots of developing countries, especially in Asia and Africa, have come to rely heavily on both the U.S. and China.
For trade,
For
investment.
both trade, investment, development aid, they've become crucial growth drivers for these economies.
So now they might have to choose sides.
That's the fear. A sharp U.S.-China split could force them into difficult positions. We're already seeing China making moves, strengthening ties with Vietnam, Malaysia in 2025, for instance.
Like building their own sphere of influence.
Exactly. And this could fragment global partnerships, maybe less aid flows overall, maybe big infrastructure projects like China's Belt and Road Initiative, which was already slowing down a bit, get disrupted further.
And what does that mean for those countries?
Ultimately, they risk losing influence. They face a tougher world with potentially higher costs for imports, less access to technology, and just slower global growth affecting their own prospects. It makes development much harder.
It really paints a bleak picture overall, doesn't it? This idea of an economic divorce seems like it would just spread pain far and wide.
That really is the main takeaway from all the analysis we've seen. Looking at these 10 points, it's hard to see how anyone really wins in this scenario.
Right.
Both the U.S. and China would likely face serious economic damage, serious disruption, and the entire global economy takes a significant hit.
So just to recap quickly, for the U.S., we're talking higher prices, broken supply chains, pain for U.S. companies, potential job losses, slower tech progress, shaky financial markets.
And for China, major economic headwinds, potentially less global influence.
And globally,
Yeah.
those fractured supply chains, volatile markets, slower growth for everyone, and real hardship for developing nations caught in the crossfire.
Yeah, and it's worth remembering what most economists say about tariffs. They generally don't fix trade imbalances effectively. The costs just get passed down. There was a 2023 report highlighting exactly that.
Right. Consumers and businesses end up paying. Yet the tensions driving this are real. The U.S. has its concerns about unfair practices. China sees U.S. actions as protectionist.
And many other countries are just trying to stay out of the line of fire, it seems.
Yeah, Europe, Southeast Asia.
Yeah.
Trying to navigate this. And all this is happening with those warnings about a possible U.S. recession in 2025, while China deals with its own economic adjustments. It feels like a fragile moment.
Very fragile, yet both sides seem pretty dug in right now.
So as we wrap up this deep dive, the big question left for you, our listener, is really, given the real issues and tensions involved, do the massive potential costs of a full split, the higher prices, the job impacts, the slower innovation, the global instability we've talked about, do those costs outweigh whatever benefits might be sought? Is there maybe a different path?
Perhaps that idea of managed competition, finding ways to address the specific problems, the real frictions, without blowing up the whole system.
Yeah, preserving cooperation where it's essential, like on global challenges, climate change, pandemics, while still competing fiercely elsewhere. It's a tough balance to strike, but maybe a less damaging path than a full economic divorce. Something to think about.